watching Businessworld Live. I'm Danie Laurel. It's the start of a new trading day. Let's kick off with our banner story. The country's biggest business group is urging the government to fully open the economy and assist businesses in creating more jobs in order to fast-track recovery. These are part of the Philippine Chamber of Commerce and Industry, or the PCCI's 10-point proposals that they plan to submit to President Duterte. Aside from economic reopening and jobs creation, the PCCI resolutions also cover internet connectivity, innovation advocacy, the ease of doing business, education, environment, energy efficiency, and agricultural productivity. The group wants the government to further open the economy now, even before herd immunity is attained, to revive pandemic-hit businesses before the economy plunges back into a deep recession. PCCI President Benedicto Yujico is hopeful that the government will heed the business sector's call. Metro Manila is under a more relaxed Alert Level 2, and Finance Chief Sonny Dominguez expects the government to ease restrictions to Alert Level 1 by the start of next year. Banking fraud losses climbed to 1 billion pesos so far this year. That's as cybercrime rose along with the increase in digital transactions. Bankers Association of the Philippines Vice Chairman for Cybersecurity, Ramon Hoxon, said the volume of cybercrimes this year is now 3 times higher than in 2019. Hoxon, who is also a top executive at BPI, said they are now seeing close to 1,000 clients getting scammed every month from just around 300 pre-pandemic. To help mitigate the situation, Hoxon told Businessworld Live yesterday that it is very difficult to track unregistered devices in cases of online fraud. That's why the group is now pushing for the mandatory registration of mobile phones to help prevent cybercrimes like fraud and identity theft. The BAP also expressed support for the government's national ID system as another line of defense against anonymous scam attacks. Checking in on the markets open, you can see on my terminal here a little bit of a pullback down by 0.4% already, 4 minutes into trade. Now recall that yesterday, according to Diversified Securities, Aniceto Pangan, majority of the Asian markets were down on inflationary concerns, and we also already had profit taking since yesterday, even ahead of the BSP policy rate setting meeting, and even as foreign buying continued. And of course, it is rate watch today. We are going to be seeing them do it from Boracay with in-person media. That is, of course, the Bangko Sentral. This, according to Governor Ben Diokno. It's been 2 years since the pandemic hit us. I'm glad that we're slowly getting a sense of normalcy back, and that is their small contribution to the normalization of the economy. Now, recall that according to a Businessworld poll of 20 economists, the BSP is expected to keep the policy rates at an historic low of 2%. Analysts have said that the BSP will continue to be accommodative as the economy has yet to fully recover from the impact of the pandemic. So that will be at 3 p.m. today, with media also present in Boracay. Now, is the worst really over? Here to weigh in, we have with us the OIC Head of Research of Chinabank Securities, Rastine Mercado. Good morning, Rastine, and welcome back.
Hi, good morning, Danny. Thank you for having me.
Rastine, let's kick off with the policy meeting that will be taking place here. So probably no surprises, 20 out of 20 saying they will be staying put. But with inflation concerns, ramping up worldwide, and that already affecting the Asian markets yesterday, how long can we stay this way, without increasing our rates?
Well, the concern in inflation has been an on again, off again concern for global markets. It seems like whenever there's a lack of a positive catalyst, that's what markets grow concerned about, right? So of course, the risks will be there. As things are at right now, global supply chains continue to have bottlenecks amid recovering and high demand. But recently, you've actually been seeing commodity prices retreat from record highs. So that in itself may be a good sign. You also had the IMF saying earlier this month that higher vaccination rates could actually help tame inflation, as this would lead to a reinstatement of capacities, which were hampered or limited due to manpower constraints and lockdown restrictions. So I think heading into next year, of course, that's something that we should be monitoring, specific to, I guess, for us, food prices, and then, of course, effects of oil prices as well. So that's one key data point to watch. But as we've seen in the inflation print from last month, it's actually lower than expected. So it would be interesting to see how inflation kind of moves over the next months.
What would investors looking at properties or banks appreciate? Would they appreciate a faster, unwinding or tightening rather? Would they appreciate that we keep in step with the inflation and the interest rates would go up? Or are they happy to stay this way for as long as possible?
Well, I think obviously for property stocks, right? Good that interest rates are low with consumers picking up, so bank financing should be good. But then again, I think banks have already started anticipating that the possible increase in rates over the next 12 months, right? So they've positioned their portfolios ahead of that. So I think really it's more a story of when that demand from consumer loans, because that has been weak based on what we've seen in the earnings reports from banks recently, with the industry is actually picking up in terms of loan growth, right? So it's that recovery that we're actually looking for. So far, looking at property stocks, they have been booking pretty strong reservation sales. So I think that also points to good months ahead for at least those two sectors, hopefully, as we continue to normalize in terms of economic activity.
Okay, let's talk about the trading that we are seeing in terms of trading activity. It's been a flight of capital. We saw some net foreign selling in the first few days, and then now we're back to buying, but it's still tepid flows. Can you say that the excitement of that week prior, where we broke through the 7,400 levels, is over? Heading into the Christmas season, are you seeing a resurgence of excitement again, or was that already the exciting part?
Well, I think even if we consolidate at this point, that's still pretty exciting. If you look at it, from the end of the first half to where we are at the peak recently, that's around close to 20% of a rally already. So that in itself is already a reason to celebrate, because I think the market is really focusing on the recovery in 2022. So at this point, if we see a consolidation between 7,000 to 7,500, that should be a good sign. This will allow for a healthy change of hands. As we all know, current levels are where we were at actually in February 2020. So that's pretty much pre-pandemic. So it really will take time, if ever. So this is the healthy spot to be consolidating at. And in terms of catalysts, right, we haven't near term. There really isn't any, considering that we've just come from earnings season. So that's of course against the backdrop of mounting risks. So inflation, you mentioned, U.S.-China relations coming back into play, looming U.S. debt ceiling. So I think it's a good place to start reassessing positions. So nevertheless, I think sector rotation will be the key for those looking for opportunistic trades. So I think bank and property stocks are starting to see some signs of life, some more robust activity following the earnings season, and hopefully in the next few months.
Rastine, is the focus now on, like you mentioned, the property stocks, the banking stocks, the cyclicals, picking up the ones that were hard hit, or will the focus be on, new money, like the IPOs? There's so much fundraising going on right now. There's been a term, IPO fatigue, na ba? Is this the right time to be, going into these new smaller players? Or is this the time to be still looking at the bigger players, the defensive stocks, and even the cyclicals that need to be picked up?
Well, I think there is excitement over the pipeline of IPOs that we've seen. Of course, part of the excitement is also investors being able to make money off of these IPOs and other offerings, right? So, but I think it's worthy to note that usually ahead of, especially the lineup of equity and bond issuances that are slated for the fourth quarter, right, is that you do see sap and liquidity in the markets, but we really haven't seen that. So I think overall, still robust demand from the market. So I know that there is some concern that there are too many transactions within a short amount of time, but I guess it's really the issuances. They really encompass a broad spectrum of exposures or specific risk factors and sectors. So I think individually, these issues have something to offer, right? So, and that's what's, for example, some particular investors might want to be exposed to those sectors. So I think each will have its specific target market as well, apart from the general appetite of the market for these issuances.
What about the REIT story? Wala pa bang REIT fatigue with all the choices of that we have, and one is coming in online. Siri, tell us, how does this differ, especially when you talk about the REIT sponsor divides? It's not the typical large property player here, and how will this be treated by the markets compared to the other REITs already trading?
Well, in terms of the appetite for REITs right now, with their share prices still pretty high up there, I think that's evident that the demand for them remains strong. So the preference for stable dividend yielding investments is very much there. Specific to the C-REIT IPO, I think, of course, as usual, benefiting from these payments, but also there's potential windfall in incremental gross revenue share over a certain threshold, right? So I guess that will appeal to specific investors, such as those looking for first exposure to stable dividends from leasing income, but also those who want some exposure in the renewable energy sector. So I guess that in itself will set it apart from the other REITs in the market.
Okay, and are you still excited about this renewable energy play? There was a lot of excitement on ASEN, a lot of excitement on FGen, and now you've got Solar Philippines trying to raise money here. Tell us, with the pipeline still far away compared to the traditional energy players, is there still excitement on these type of sustainability stocks?
I think yes, very much for us. Demand for electricity continues to pick up. You have a moratorium on new coal plants, and then of course the government is trying to reach 50% renewable energy share by 2030. So right now, I think early this year we were at around 33%. So I think that's apart from obviously these companies taking advantage of that demand and of course that market that needs to be filled. I think generally that's where the direction of the whole sector is going, right? That's the secular story of the power gen sector moving into renewable energy. So I think this is part of the start of that interest, with investors slowly really shifting attention into more RE projects, especially considering their of course sustainability considerations when it comes to their investments.
What about MediaLines, which has set their IPO price at 2 pesos and 30 centavos? It's lower by 6.12% than what it originally wanted. Is there still excitement in terms of medical stocks? This was the focus, during the height of the pandemic in 2020, the Nasdaq. Parang is it too late na ba now, or does this still have an exciting IPO story?
Well, I guess one evidence of robust uptake is that it priced near to its maximum offer price, right? So I think that's indicative of two things. One, robust demand. Heading into it, I think, again, market liquidity has remained strong. You have that IPO pricing at that point. So I think that is a good sign. And then, of course, it's also the first of its kind, right? So a healthcare play here is really going to attract investor attention because it's the first healthcare play here. Of course, that story is also underpinned by tailwinds from the universal healthcare law and continuing spending in healthcare facility expansion. So I guess there in itself, based from regulations with the universal healthcare law, I think that is in itself is a story for MediaLines. So I think there will be much interest over that stock in the coming months, at least.
But will you say that the price is now more affordable, even if as they didn't slash the IPO price, as you mentioned, dramatically?
Well, I think it's really more on exposure and how you want to balance your portfolio, right? So, of course, there is growth prospects will normally be priced in IPO pricing. So, I think that only indicates that the growth prospects of the company look to be strong, right? So, I guess that's one thing to take a look at, especially as it executes on its plan, and of course, how the business performs over the coming quarters.
Final sector that I wanted to ask about, airlines. And should
Mhm.
we be picking that up now? Joining the rest of the central bank in Boracay, for example. But really speaking, you've got Cebu Pacific now saying that they're flying, I think, at 40%, nearly 40% of domestic capacity. They're going to be hitting more than half the targets in December. You've also got PAL, saying that their traffic is improving. Is now the time to get back into not just the airlines but the travel and leisure stocks?
Well, of course, that's a good sign, right? the airline companies starting to rebuild capacity. With more industries starting to ramp up to near full capacities, case counts continue to be manageable, government efforts to still ramp up vaccinations and, of course, third doses. It's only a matter of time before people start resuming their pre-pandemic activities. So I think one term that has been seen is revenge travel or revenge tourism. So those that have had cabin fever for quite some time, starting to find that opportunity with case counts near month lows. As of course the time to actually, okay, maybe it's time to try it out again. So I think the good thing is with industries such as these, right, where the time horizon for planning is a lot more longer because of course you have to rehire staff and then rebuild your capacity. So I guess really over the longer term, that the outlook is that it will continue to recover, right? And that's what we've been waiting for. So now that it's here, I think it's really just a matter of time before we get back to the foot traffic that we've seen into these companies, right? So hopefully we see better figures over the next months.
It can't get any worse, basically. That's what we've seen. All right, thank you so much for those insights, Rastine, Mercado, Chinabank Securities.
Thank you for having me, Jan.
Here are other headlines we're keeping our eyes on. Oxford Economics expects the Banco Central to maintain the rates until the first quarter of 2023 to support the economy. The think tank believes that the recent CPI surge is transitory and supply side driven. It considers current inflationary pressures temporary, which reduces the likelihood of a rate hike next year. Oxford Economics expects the temporary inflationary pressures to unwind in the coming months as food prices stabilize, while imported inflation will likely subside by next year. Recall that inflation eased to a 3-month low of 4.6% in October. As food prices slowed, this was the third straight month that inflation exceeded the 2 to 4% target of the BSP for the year. Fitch Solutions Country Risk and Industry Research expects the Duterte family to retain influence in policy making even after the 2022 polls. Fitch Solutions says the country would likely see broad policy continuity because of this continued influence. In a note released yesterday, the think tank said it retained its short-term political risk index score of 64 for the Philippines, where a score of 100 indicates lower risk. But among the presidential candidates, Senator Bongo is seen to offer the most policy continuity because of his ties to Duterte and the ruling PDP Laban party. On the other hand, Fitch says former Senator Ferdinand Marcos Jr. poses risks of more authoritarianism since he reflects Duterte's strongman strategy and supports the dictatorship of his late father. And that's the first look into the business day. Today's Thursday, November 18, 2021. Catch Businessworld Live for the market close. It's at 3:15 p.m. today. I'm Danie Laurel. Mask on, wash hands, stay safe, Philippines. We are One News.